Good morning, everyone. Welcome to Siloam First Half 2025 Earnings Call webinar. I'm Vivian, the investors of Siloam Hospitals. In today's webinar, I am joined by Bu Karan Riyadi as Siloam CEO, Pak David Utama as Siloam's President Director, Pak Daniel Phua as Siloam CFO, and Pak Sumanta as Siloam COO. In today's webinar, it will be started by Bu Karan Riyadi for the opening remarks, and after the presentation, we will open the floor for Q&A. Just for a kindly reminder, for participants who want to ask questions, please kindly use the Q&A box below. Thank you. Please, Bu.
Hello, good morning, everybody. Thank you for joining us for our first half earnings call. We have a lot that we want to be updating all of you today, and also with a view of how we should be seeing our Q1 and Q2 as well. A lot of progress on our strategy that we'll be sharing, as well as on our brand. Today, we will be starting with our financials first, and then we'll be moving on to an update on our archetype transformation strategy of our 4 networks, and a little bit about some of the events that we have done and the brand modernization project that we'll be rolling out. Without further ado, passing it on to Daniel. Go ahead, Daniel.
Thank you, Caroline. Thank you once again for your ongoing support and taking the time to attend Siloam's first half earnings call. I'll start with the financials, going through in regard to the revenue. Vivian, next. So if you were to look at the second quarter's revenue performances compared to the first quarter's, the performances is as a whole relatively flat. I mean, they're growing by 1.3%. As most of you know, that is due to the factor of seasonality. In the second quarters, I mean, due to school holidays, liburan, and so forth, there's generally less productive days, and I think it affected the revenue for the hospital industry as a whole. From a first half perspective, revenue is also relatively flat, an improvement of 1.5%, first half 25 to first half 24, ending at a revenue of 4.73 trillion. Now, again, coming back due to the same factors we've mentioned earlier, that is, there were high disease seasonality in the first half of 2024, such as dengue, that really affected the revenue for last year's. But once that is normalized, therefore, we are seeing that the results to be, flatter, I mean, compared to the year before. But I think what's also important to highlight at these junctures is that as management, we do believe that the long-term executions of our strategies and making sure that there is a sustainable growth in our revenue is far more important than trying to manage the quarter-on-quarter movement, which will always be affected by seasonality, macro factors, timing, and so forth. Part of this is, as an example, right? Most of you would know well that there has been a lot of pressures from corporate and insurance over the past year or so. So Siloam has actually deliberately stopped some accounts due to either excessive receivables, but we have actually stopped some of these accounts whereby the receivables amount get too high. We have also stopped some accounts because the discount that is being requested was too high, and we weren't able to come to an agreement. Now, in some cases, there were some accounts that were stopped and reopened due to, obviously, the demand for Siloam services. But as management, we do believe these risk management activities are important for the long-term sustainable growth of Siloam. We could have, for example, allowed the accounts to operate despite excessive high receivables. We could have allowed accounts to continue to generate revenue despite the high discount that is being requested. But we don't believe that is in the best long-term interest of Siloam and its shareholders. If internally we have calculated, if we were to normalize for some of these accounts that we deliberately stopped or closed, but revenue would have increased in first half of 2025 by about 4.7% compared to 2024. It's similar stories when we come down to EBITDA and cost. I will have a further slides on cost that I will talk about it in more details. But cost has been well managed as a whole. But due to obviously the flattish revenue, EBITDA margin would have dropped. But obviously on absolute term, EBITDA improved by 21% due to the write-off from last year. But if we were to look at it on underlying basis, EBITDA dropped 5.8%. Again, that is largely due to various expenses that has been spent on capability building. I would get to that in some further slides further down. Net profit, again, on the total basis is up 42%, but again, that was a write-down of 309B last year, as you may recall, due to assets that we will no longer open. But if we would look at it on an underlying basis, it would have decreased 26.1%. Again, a large part of that is due to some of the corporate costs in regard to taking out the 14 trillion loan that you're well aware of, and also in regard to basically higher rental impact from the PSAK 73 calculations. But most of you may understand the fact that our rental for the first three properties are calculated based on last year's revenue. So it's a percentage of the year before. So when the revenue for this year is flat compared to the year before, relatively speaking, the quantum of the rental increase becomes higher. But these fluctuations obviously is unavoidable considering the current arrangement, which is also why Siloam is currently actively working with First REIT, as I mentioned to you previously, to buy back the First REIT properties. And we are still targeting to be able to complete that within this year. Next, so in regard to the throughput, as mentioned before, due to seasonality, holidays, due to deliberate actions from Siloam for a risk management perspective, throughput is relatively flat, both on a Q-on-Q basis and also on a year-on-year basis. But I think what's more important, though, I do want to share, next slide, is the fact that despite a flattish throughput, our ARPOB has improved compared to the year before. But again, this is in line with the NGS transformations that we have been telling you so often, that our focus is to continue to improve on the complexity and acuity of our services. Carol would talk later on about for example, the robotic knee surgery that we have now rolled out in the Surabaya Gubeng. But you have heard us talk about the Da Vinci XI that we have implemented. And we continue to invest in getting the top doctors with regard to from the subspecialists that will be able to improve the complexity and acuity of our services. So as you can see in here, the average revenue per occupied bed, 1H25 to 1H24, that's improved by 8%. Average revenue per patient days has similarly improved by 3% as well. That remains a key focus for management, because coming back, we are here to build long-term sustainable competitive advantage. And we do believe that by basically building up our ARPOB, this will form part of our key strategy going forward. Next. Yeah. In regard to the payer mix, but it is relatively stable. The BBGS payer mix has dropped from 18.1 to 17.1%. You will see that the corporate insurance relatively stable at 50 to 49%. A lot of growth came in from the OPE segment. But I think this picture doesn't give you the full concept in regard to what Siloam is doing in regard to the archetype, or what we now call the network strategy going forward. So Mata will share about this further during his presentations. Basically, we are now looking at the payer segment per archetype or per network. Obviously, for the community generalists, their role is to be able to grow the BBGS segment, whereas for the premium specialists, for example, their focus is to grow the non-BBGS segment. I mean, in line with obviously the segmentation approach that we have outlined in the archetype strategy. So Sumata will share about that a little bit more on a consolidated basis, but you probably don't see much movement. But on a archetype by archetype basis, you will see that there has been a shift in payer mix in line with the strategy of the archetype. So as a whole, 1H24 to 1H25, the OPE grew by 7.2%. Corporate and insurance relatively flat. with BBGS going down by 4.3%. Again, as I said, you see further outline of that when Sumanta break it down by archetype or network. Next, Vivian. So coming into the cost, right? Obviously, as I mentioned earlier, EBITDA margin is down 5.8%, but due to the fact that revenue is flat. But as you can see, operating expenses went up by 6.6%, 1H 25 versus 1H 24. I think it's important to explain some of the context in regard to the cost increase. But a lot of the OpEx increase was related to capability building, as we shared earlier, in regard to the friction cost in relation to the move to the archetype, and in relation to, say, for example, building up our cloud infrastructures. This year, there's a major push to move our server to the cloud, and that move is quite important in order to support our AI strategy going forward as well, because we do need to have the data centrally managed in one place in order for a lot of the AI strategy to be effective. So if we were to exclude some of the basic capability costs that we spent on the cloud and also for the transformations, OpEx would have increased by only 2.6%. Obviously, this is far below the minimum wage increase of 6-ish%. A large part of that is due to various initiatives that management will still continue to execute to find efficiency and opportunity to improve productivities along the way. So if we were to, as I said, I mean, if we don't do cloud, if we don't do some of these transformations that we are executing, operating expenses would have been flat. I mean, EBITDA would have been better. But as I alluded to earlier, we do believe that by making sure that Siloam has a sustainable growth profile is much more important than managing kind of a quarter-on-quarter performances. Drugs and clinical supplies, that is relatively flat, as you can see in terms of percentage of revenue. First half of 24 is 28.2%. First half of 25 is 28.9%. Some of this is really due to some movement in case mix in between the semester, in that there were kind of more chemo cases coming in, and those cases did have a higher drugs and material cost components. But again, some of those things are mainly timing and even out over time. The underlying net profit I alluded to earlier, I mean, it is a 26.1% decrease. A lot of that is, again, corporate costs related to transformations, settling the 14 trillion loan, for example. And also, as I mentioned, the rental, because it's based on last year's revenue increase, it would have basically, from a relative percentage basis, have a higher impact on the net profit compared to the EBITDA. Moving on. So cash flow, I think, is still looking strong. Working capital days, we have improved from 8 days in 1H 24 to 6 days in 1H 25. Operating cash flow decreased by about 14%. That is largely due to temporary movement in some of the tax payments, and also higher interest as a result of the 1 trillion bridging loan that was taken out towards the end of 2024 for the buyback of 3 properties as part of the 14 properties buyback that we are going to execute. But I think just looking on operating cash flow, it really doesn't give you the full picture. I mean, we have shared during the first quarter that we have settled a 14 trillion syndicated loan from a number of banks that have supported us. And of the 14 trillion, 11 trillion is earmarked for the buyback of first 3 properties. So that leaves us another 3 trillion that we can deploy for other purposes, CapEx, including M&A. Siloam, as I mentioned to you previously, has been in a consolidation phase of the last 5 years. We want to make sure that our back office, our processes, our systems are robust to be able to support ongoing growth going forward. We do believe that 2025 is the year whereby we can be a bit more aggressive. I mean, looking at expansion. But Greenfield, we still plan to open 1 to 2 hospitals each year, so that hasn't changed. But I think what is different now is that, especially with the additional facility that we have in place, we are now more aggressively looking at M&A opportunities to support the growth of Siloam. As I mentioned, we do believe that by identifying areas or regions whereby we lack a presence, And by looking at the good target brownfield M&A opportunities, that is a way to build out long-term sustainable growth for Siloam. I think since the start of this year, we've evaluated over 30 potential targets. We have shortlisted about 5 or 6 that we're currently working in more detail with the sellers. But obviously, M&A timing price is critical. We are not going to rush it just for the sake of trying to close deals. But we have been mainly looking at more premium hospitals that are EBITDA positive. So we do believe that once some of these M&A deals gets executed, they will be immediately EBITDA accretive to the performances of Siloam. So again, tying that back, that is in line with our overall focus on long-term growth and long-term sustainable growth in regard to the performances of Siloam. I mean, just to share, for example, I mean, some of you may remember during COVID, we only opened 3 hospitals for COVID, whereas most of our peers basically opened all their hospitals for COVID. Now, obviously, at that time, our revenue growth was slower compared to others who would have used all their hospitals for treatment purposes. But you will recall that our post-COVID recovery then becomes faster, and because that was a deliberate decisions from Siloam, such that hospitals who are non-COVID will continue to build on the other craft group instead of being solely dependent on the COVID. And so similar thinking and strategy, so we are really focusing on the long-term growth rather than trying to manage kind of a quarter-on-quarter performance and meeting benchmark. And on that, I do believe that the execution is on track. I mean, Sumanta will share with you later on about our NGS transformations and archetype implementations progress. And internally, we are very excited about the, you might not see that in the results immediately, but certainly we are seeing the change in approach and strategy is allowing a more focused and sharp implementations of our patient services that fits the segments that we need. But again, I'll let Sumanta, I won't steal his thunder, I'll let him talk about that in further details. That's all from me from a performance update. I will pass it to Sumanta to talk about the network updates. Over to you, Sumanta.
Thank you, Daniel. Next slide, please. So as Daniel mentioned that we are looking at the long-term growth, and NGS and our archetype strategy is the key cornerstone for this long-term growth strategy. So if you, as we have mentioned earlier in our earlier earnings calls, obviously there are 4 networks that we are splitting the entire group of hospitals into. We have been on this path for the last quite a few months, with premium specialist having 6 hospitals, premium generalist at 9, value seeker at 13 hospitals, and community generalist on 13 hospitals. Now, premium specialist and premium generalist are very focused on driving clinical acuity and driving the best treatment in Indonesia, where value seeker and community generalist are more local market focused and are focused on operational excellence. So I'll just share what's the progress been over the last couple of quarters. Next slide, please. So as I mentioned, our premium networks are focused on clinical acuity, premium specialist and premium generalist. So we have, as a very focused strategy, been moving very fast on doctor recruitment. So we have been recruiting a lot of doctors on these archetypes. At the same time, we have also looked at partnering with global institutes of repute and do proctorships and technological knowledge transfer and training so as to kind of reach to their standards. At the same time, we have also gone ahead on the path of moving towards advanced procedures. Da Vinci Xi, the first in Indonesia. Bu Carol will talk about it later in her section, and various other robotic TKR and CABG, etc. So on the clinical acuity part, we are very focused. We are driving growth on that side. At the same time, as Daniel mentioned, after a certain period of consolidation, now we are looking at adding newer facilities, newer equipment. Many of them are in place in H1. Some of them are coming up. as well as very focused on the non-BPJS business, especially corporate insurance and referral. In referral, we are focusing on complex surgery referrals at a national level, as well as in corporate insurance, looking at increasing the share of Siloam in that business. Parallelly, we are also looking at conversions as a key metric to drive the non-BPJS business. Next slide, please. As I mentioned, that the international global partnerships are a very important cornerstone in driving clinical equity. So in first half, we have completed 4, 2 of them across cardiology and urology surgery with NUH in Singapore, 1 with University of Hamburg in Germany in cardiology, and 1 with Changi General Hospital in lung diagnostics. And we have a far more longer slate for the second half of the year. So this is one part. The other part is obviously driving clinical summits. So this is, again, as you understand, these things would kind of drive clinical equity for premium specialist and premium generalist. We had a very successful Siloam Oncology Summit with over 700 participants, including MD Anderson in the month of May. In July, we had a very successful digestive summit. Upcoming next week, we have a Euronephro Summit in Jakarta, just next week. And next month, we have the Neurosciences Summit. So across Congo Euronephro, we are driving clinical equity also through these summits, which is a very strong clinical knowledge exchange for our doctor community and to the external referral doctor community also, with participation of international partners. Next slide, please. While the non-premium networks, the value seeker and community generalist, continue to focus on operational excellence. So that is the beauty of our network strategy, that each network is focusing on each areas. So premium specialists and premium generalists continue to focus on building clinical equity, adding doctors, etc., while these other 2 networks continue to focus on case mix management, where how to manage the proper BPJS case mix, COB, adding COB more to it, improving facilities, looking at utilization, looking at OPEX optimization, etc. So this is more about efficiency. So VS and CG. Next slide, please. And if you look at the results, it is actually starting to show. Now, if you look at the non-BPJS focused networks, which is premium specialist, premium generalist, and value seeker, the non-BPJS share of revenue quarter on quarter over Q2 over Q1 has actually increased 1.3%, from 81.9% to 83.2%. Also, if you look at the average monthly share in H1 over average of 2024, that is 1.5% higher non-BPJS share over the commensurate period. So we have been very clearly moving our case mix towards non-BPJS on these 3 non-BPJS focused archetypes. However, we also have one archetype which is more towards serving the community, which is community generalist, which is BPJS focused. Their BPJS revenue has increased 5.8% quarter on quarter, and over the last 6 quarters, there has been a 10% increase in the growth of BPJS revenue. So with our network strategy, we are very clearly able to look at individual strategies of how do we drive our case mix. And with all the efforts which we are doing, as I mentioned in my last few slides, we are able to see very clear movement in the direction we want the long-term case mix to move. That's about from my side. I will hand it over to Buchanan.
Thank you, Samantha. Thank you, Daniel. At the risk of being redundant, I'm gonna repeat a few points that you've heard from Daniel and Samantha, because I think this is important. Sorry, no, can we go back to the slide before? Thank you. So I think a few things to note, a few factors that have affected our first half. I think number one is seasonality. Last year, beginning of year, we saw an unusually high seasonality for even those months. And May was the last high month of seasonality in 2024. And therefore, coming out of Q2, there will be a lower base. And so you'll see a little bit more growth because the base is lower, because the seasonality is no longer there starting in Q3. And if you normalize seasonality and some of the pair volatility, as Daniel has mentioned, our growth would be at 4.7%. Now, the second thing to note is around the pair volatility. That's number two. There was a business decision to temporarily halt or discontinue certain accounts due to either excessively large outstanding accounts receivable, or a request for unsustainably high discounting that would not work for our business model. This is not the first time we've done it before. I think there were some accounts at the end of 2023, which we have then recovered. But for us, it is important to make sure that we are driving profitable growth. And the third thing to note is that the costs are managed. There has been significant investment going into growing digital capabilities, as well as our NGS strategy. That makes up for more than a third of the OPEX increase to last year. So what are we doing in essence? In essence, what we're doing is, one, we're maintaining sustainability and profitability of our operations for a stronger foundation going forward, looking at more of the long-term gain and avoiding a knee-jerk reaction or benefiting from short-term gain, but then sacrificing long-term gain. We are investing in capabilities for future growth, and our strategy will deliver growth. And you've started seeing some of the benefits that are now materializing. For example, in the shift in the pair mix of 3 out of our 4 networks, that should be seeing a better mix. Now, our community generalist network is a different model, so we're not going to be pushing for a better payer mix there. But 3 of our 4 networks are moving in the right direction in terms of payer mix. And as you can imagine, it will be better when we're growing with the right payer mix and doing this now rather than doing it when we're much larger operations. Now, corporate and insurance, you know that there has been a lot of volatility in this area. It has been picking back up in the past 1 to 2 months, and so we're very happy to see this. It continues to be a challenging market with some degree of volatility, but it is moving in the direction and much more settled than last year. Many insurance payers are coming out and moving away from a survival mode and talking to us about looking at growth, collaboration, partnerships to serve their clients and serve our patients better. And so we know the mode is changing, the focus is changing for them. And when they grow, we will grow together with them. And so we're optimistic about the end of this year, the remaining of this year, and as well as the coming years to come. We believe we have been and still are in the right place and the right time to take advantage of the coming growth in the next few years in healthcare in Indonesia. We know health is a focus for the government. There's a lot of regulatory transformation that has been done and driven by the Ministry of Health under Pak Budi. And we continue to see that our country continues to progress on this, not just on the regulatory level, but as well as in practice as well. And when this happens, this will yet again open new opportunities, and you can be sure that we will be the first or at the forefront of pushing for this and taking advantage of these opportunities. Our teams have been working very hard. We really do have the best talent in our country. I'm so proud of our teams, and we're excited for what we will achieve in the coming years. So a little bit about some of the events that we have done. Next slide, please. This quarter, we have done a lot of activity in digestive and robotic surgery. We had another successful and well-attended summit for digestive. Our summits are becoming the go-to summit in Indonesia, and people do look forward to them. We are getting better and more speakers from more and more institutions worldwide. This year, the focus is on minimal invasive and robotic surgery. a lot of benefits and objectives achieved through the summit. One is training and education through proctorship. This time we had an Indonesian Indonesian born robotic surgery expert from Tampa. So he is Indonesian, but he has grown a very successful robotics program in Tampa, Florida. Professor Iswanto Sukandi and Dr. Sung Jae Myun on advanced surgery techniques from Korea. We were also, again, fostering a culture and a spirit of collaboration across our disciplines and building a referral network to our centers of excellences from other hospitals and centers across Indonesia, which is how we build volume and a critical mass as well to the programs that we do. Next slide, please. Da Vinci grand launch. You've heard about the Da Vinci. We did a grand launch by the minister who applauded our breakthrough move in pioneering and promoting robotic surgery in Indonesia for better patient care and clinical outcomes. We truly believe it will. Robotics has opened a way for surgeons to overcome limitations of the human hand, such as reducing tremor, unintended movement, greater flexibility and rotation, allowing surgeons to access the abdominal cavity, explore difficult areas, remove tumors through very small incisions. That means less pain for the patients, less risk, and faster recovery. Next. Expanding our network is still a very important part of our strategy because it provides future growth capacity in new markets or in existing markets. We believe these projects will also provide good returns for invested capital. We are also actively pursuing M&A opportunities in target markets. Next. Our new building in Surabaya Gubeng will be in operation soon. You've been hearing about this building. It's actually coming in and we will be operating very soon. It is by far the most modern and premium facility in our network, and it will be the standard for premium facilities going forward. We will be doubling the number of specialist FTEs or full-time equivalents. So that means we're going to be doubling the number of specialists in this hospital. And we will be launching new programs and services that were not supported in the old building, which makes me very excited. This includes an open heart surgery program, which I've been wanting to do for the past 10 years, but was not able to do because it's a small building and the limited operating theater space. Advanced digestive and endoscopy program, medical rehabilitation, and advanced orthopedics, including QVIS, knee robotic surgery. Again, I can go on and on about the benefits of robotics in this field of medicine, but for time's sake, I'm going to skip that, maybe for another time. Next is our awards. We have been given a number of awards this quarter. One is for our achievement in sustainability and emissions reduction. As we have said to all of you, it is important for us that we operate sustainably and mindful of the context that we are in, the world that we are in, and how we should be good stewards of what we are doing. We have 2 awards from SWA and 2 awards from Newsweek, Best Specialized Hospitals in Asia Pacific, acknowledging the level of clinical work that we do. Next. I am also very pleased to be finally sharing with you the culmination of our brand modernization project. And therefore, I present to you our new logo. Next, please. This new logo has been designed to retain main elements of our logo and brand. It is a refresh. It is not a transformation because we believe that there is a familiarity of the brand that gives confidence to patients and the communities. And so therefore, the new brand is familiar. It draws on the brand strength we have built over the past 4 decades. It is modern, but relevant. It communicates trust, precision, and strength. We will also be launching our new brand differentiation strategy next, which is based on our archetype strategy. So basically everything that we've been doing is by and large internal, changing the payer mix, elevating SLAs, bringing in efficiency, as Samantha has shared with all of you. I mean, a lot of that is internal facing, but how do we communicate with our patients and our stakeholders about the value proposition of each of our networks. It is through our brand differentiation. So our premium hospitals will use the brand Siloam International. Our value seeker hospitals will come under the Siloam brand. Our community generalist hospitals will use the name RSU Siloam, which stands for Rumah Sakit Umum Siloam. We will be retaining BIMC as a separate brand due to its strength in a very niche market, which is the Bali tourist market, and is very well-known and trusted brand in that niche market. MRCCC will also remain because it has developed such a strong association with advanced oncology care in Indonesia. And we will also use Siloam Heart Hospital and Siloam Orthopedic Hospital for our specialty hospitals in cardiology and orthopedics. Next, please. I just wanted to share with you what it would look like. These are some examples of applications of the Siloam International brand on the building, marketing collaterals. Then you will see the next one when we use the just Siloam brand for value seeker hospitals, and also our community generally hospitals will use RSU Siloam. And as you can see, this feels a lot more local when you put RSU Siloam, but it is also familiar. People know the Siloam brand. The Siloam typology is classic, and so people know they're associated with the Siloam brand, but of course RSU would give it a more local feel. We hope that as we modernize the brand and differentiate its use between our networks, it will help us better to communicate with our patients and the community, again, communicating trust, precision, strength, and continuing what we've done over the past few decades and continuing the legacy that has been built over many, many years in Indonesia. So that ends our update. And so I will hand it back over to Vivian for question and answer. Thank you, everybody.
Thank you, Bu. Pak David, do you want to have a conclusion to conclude all the presentation, Pak?
Sure. Thank you again, Bu Carol and Daniel and Pak Sumanta for the earlier presentation. So I'll try to bring this to close. The one thing that we've always said, that Siloam's ability to execute has been our core strength. That's why when you look into the strategy that we put Next Gen Siloam, everything is truly becoming transformational through the execution. So the one thing, if you listen to everything that has been presented to you by Daniel or Sumanta or even Carol, is we never compromise on the patient outcomes. And that's what we do through our clinical programs. So that means we continue on the focus of enhancing clinical complexity in our premium hospitals. We continue to drive efficiency in the community generalist and value seeker segments, and exploring organic growth and strategic M&A, as what Daniel has said. We have 30 plus pipelines that we are going after, and we have shortlisted of 5 plus M&A opportunities. But our strong performance was basically driven by a blend of strategic and operational and clinical innovations. I can mention a few just to reiterate and close on our presentation. One, Carol has mentioned about clinical innovation and service expansion, where we put a robotic surgery program through our sites. And also to mention that Siloam is a stroke, we have 12 facilities that is labeled as stroke-ready hospitals with international recognized stroke protocols. And also on the strategic optimization, the network efficiency has been a focus and a strong point of us, where we maintain discipline through the operations. And you heard Daniel said that ARPOB, average revenue per occupied bed, has risen 8% versus last year. and the average of revenue per patient day has also increased 3% versus last year. So basically, this is signaling an improved monetization of our inpatient services. Financial discipline has always been also a key rigor for us to drive the business. And to maintain this financial discipline, you see through the presentations that were presented, we maintain a tighter cost control, and also we drive better case mix. On the diversified revenue streams, you saw from the earlier presentation that we continue the expansion into outpatient services also, and the premium procedures also help us to offset some of the declines in the inpatient volumes. Infrastructure growth has been a key focus. Daniel mentioned that we are to support with future growth. And you see on the slide before that we have 6 greenfield projects and 4 brownfields, right? So in general, we're adding about 10 new sites and expansion. So that concludes our presentation. But I'm very thrilled that really Siloam is really focusing in the long-term growth. And that's why our Next Gen Siloam strategy is really starting to show indicators that it's moving in the right direction. It is definitely one of the best strategies that we have implemented, and we continue to be excited that we will bring value to the country. With that, I'll give it back to you, Vivian.
Thank you, Pak. Just for a kind reminder for all panelists, if you have any questions, please kindly use the Q&A box, and we will try to answer your questions.
Maybe let me try to take some of the first one. Hi, Ari. The volume growth for 2025, look, we do see that, that the seasonality factors should normalize. And therefore, on the revenue perspective, we should see kind of a low to middle digit growth. That's what we said early on in the year. In regard to private insurance tariff growth going forward, I think well, Samantha may add on that. I think it is important to share that a lot of the tariff discussions have been successfully closed, but a lot of major ones have been closed as of June 2025. I mean, so that should provide a stability going forward in regard to our revenues. M&A, but we are basically preferably looking at the network of hospitals. But that would be preferred to obviously standalone hospitals. The target profile, as I mentioned, we are also preferring to look at the premium segments. But obviously, there's what you would like to have and what is on the market. So we need to balance up on what is available. And the M&A, I also want to say, is that it's intended to be strategic. It's not going to be, let's just go buy whatever is there and available. We have done a detailed mapping in regard to regions or areas whereby we lack presence, and therefore we would like to be there, and we mapped out the potential targets there. So yeah, those discussions are ongoing. What are the hurdles moving forward on first rate? I mean, I will answer the first 3 questions here and probably not again. I cannot comment because first rate is a publicly listed companies as well. Suffice to say, they wanted to make sure that they get all the proper regulatory approval on the Singapore side, and I do believe that that is important. We are still targeting to be able to complete the transactions this year. I mean, from Siloam's perspective, everything is ready to go. As you can see, we have already kind of negotiated and got the syndicated facility to be able to support this. But at the end, firstly, just need to get the necessary unit holders and regulatory approval on their side.
So if I may just also add to Daniel on the private insurance tariff growth point. While we are very clearly seeing signs of stability across major private insurers, elevated claim ratios, while it still continues to be an issue, but the rate of growth of claim ratios year on year, as we understand from various insurers, is going down, and it's down to single digits year on year as of 25 over 24 from a high double digit earlier. So things are stabilizing, and as a result, we foresee insurance growth and thereby our share of insurance growth also going forward.
Okay,
Yeah,
Pak,
uh,
should we give Pak Maynard since he has raised hand from just now? Dear Pak Maynard, you can talk now. Sorry, Pak Maynard, you can unmute your mic. Yes,
Yes. Sorry, can you hear me?
yes, Pak, we can hear you.
Okay, thank you. Thanks for the opportunity. I just have two quick questions. Firstly, on the BPGS, as we know, there will be a single standard. So, what will be your strategy for your community generalist hospitals, especially in the face of the new regulation potentially? Although we know it's been delayed until the end of this year. And then second, in terms of the expansion going forward, would you still be focusing um, mainly on the premium or the value seeker? Could you give us a sense which segment that you will be looking at in terms of M&A? Thank you.
Okay. Sorry, Carol, you are taking this?
I'll
or-
take the first one. So I think that in terms of the single tariff, Maynard, this is the single standard. In terms of compliance to the single standard, that we have been working over the last few months. So for sure, we're in compliance to that. So that part I'm not worried about. I think what we're waiting for is the tariff itself. The BPJS has yet to release the tariffs. So the single tariff itself is not a bad thing, right? That it would be single. That means it would reduce the patient stopping from one facility to the other because they would be able to be referred straight to certain facilities. But I think that what we're waiting for is the tariff. I mean, what we've heard is probably it's going to kind of be an average of the three classes. Class 1, 2, 3 would kind of average out to the single tariff is what we're told. But I think what we need is the finer details. Because you know that like with BPJS, there are certain cases that are profitable for us to do in that we are able to do it sustainably. And there are other cases that we run such a big loss in doing. And therefore, it'll be interesting to see how they adjust the tariffs. It's not going to be a blanket increase or decrease overall. And so I guess long story short is we'll have to see what the tariffs are. But anyways, everybody is in the same position, level playing field. So I think it'll be fine. But we need to wait for the tariff. And our hospitals are already prepared for that.
Okay, thank you.
Oh, so the M&As?
Yes, on the which target segment that you will be looking at.
What Daniel, I think going back to what Daniel said, that it is a strategic acquisition that we're looking for. So we're not looking to acquire anything. But I think a few things. One is to open up lucrative markets where we are not operating in yet. Number two, looking at acquisitions where we see that we can create value. So the price is right, the market is right, we're able to ramp up because of the capabilities that we have, because we know the business. And number three, of course, we are going to be looking at tending towards premium and value seeker hospitals. But of course, then the pool becomes much smaller. So we have to be a little bit more patient. And I think number four is anything that would be strategic in nature, complementing the operations that we already have. So let's say in a certain market, we're already very strong in the premium market. such as the Bali market, we do miss out on the value seeker market in Bali. So that's an example, right? Not quite premium, but if there was a value seeker opportunity in Bali, we'd be interested. So that is kind of objective number 4, strategic, complementing what we already have.
Thanks, Bu Carol.
Maybe I will try to answer the questions in here. The increase in medicine costs, as I mentioned earlier, I mean, there's a movement shift in the case mix, largely due to larger chemo drugs. But as I mentioned, chemo drugs do have a higher cost component. What has led to an increase in depreciation? Well, we have continued to invest on our equipments. As you can see, CapEx year on year have continued to go up as a result of our strategy to increase accuracy. But that obviously would then lead to higher depreciations. Maybe I'll let Sumanta answer the BPJS questions. The syndicated loan, yeah, look, the remaining 3 trillion is obviously working capitals and CapEx expansion purposes. We're not going to use 3 trillion just for working capital, but mainly that will allow us to have some fund available if we want to do strategic acquisitions.
Yeah, sorry. On the BPJS question, obviously, if you look at it, a blended part which Daniel presented, it may not look very different, but if you refer to the slides which I presented, because we are looking at very different focus on different networks. So if you look at the non-BPJS focused networks, which is premium specialist, premium generalist, and value seeker, you will see a good enough movement. And it is increasing as we go along for a movement of the BPJS, non-BPJS mix positively on the non-BPJS side. However, do bear in mind that we have one network which is focused on BPJS and where we kind of serve the community. So there it will increase. So at some level, at a blended way, if you look at it, it may seem not as different, but as you go down the network level, one is able to see a good enough difference. And it is, like I mentioned earlier, it is increasing as we go along quarter on quarter.
Yeah, and I think that we're also throttling it with the non-BPJS business growth as well, because we don't want to be in a position where we have an empty hospital. It's not good for the P&L. It's not good for the doctors because then their income will decrease and then they'll start looking for other places to practice. It's not good for our staff because we also don't want to offload capacity either. I mean, we have some networks growing non-BPJS in the teens percentages, right? And so when that happens, then we're able to decrease BPJS a little bit more. But of course, we want to throttle it properly as well. And also making sure that we do the right thing for patients as well. Oftentimes, it's about what the right balance is. When we put some administrative and process bureaucracies on some of these hospitals, a lot of the patients will switch to non-BPJS. But there will be some patients that cannot afford that, right? And so we want to be mindful of that as well, doing the right thing for our community. And therefore, we don't believe that that shifting the mix any more drastically than we have been is a good thing. Now, of course, from month to month, it differs as well. On months where there are a lot of holidays and there's like the Liburan month, there was, what was recently? It was Liburan. So like a Liburan month, then typically you'll see less non-BPJS business, and typically the mix will be a little bit higher. We'll see more BPJS. And so month by month, we're also managing as well. And so it's not a straight line that maybe might come across when we're looking at a consolidated number. But yeah, thanks for the question.
Yes. If there's any more questions, then please kindly use the Q&A box. And then if there is not, then I think we could wrap today's Siloam's first half 2025 earnings call webinar, Pak Bu. Okay, okay, thank you everyone for attending today's webinar, and we'll see you on the next webinar. Thank you, Pak, Bu.
Thank you, everybody.
Thank you.
Bye.
Bye.